I'm going to focus on how you can live within your means by actually increasing what you spend on the things you enjoy, because we reclaim the cash that's rightfully yours from the IRS, from interest overpayments and banks and institutions, from investment companies and the fees that you pay there, and insurance companies where I know you guys probably love insurance companies and enjoy giving them your money, but I'm going to show you how to give them less and still transfer your risk. Good morning.
Good morning.
5-day weekend. Yeah. That's not about like, someone said, oh, it's like 4-hour work week on steroids. I'm like, well, no, it's not, because that would be like, be more frugal, outsource more things. Like, it's really about, hey, let's show you how to keep a lot more of every dollar you make without budgeting. That's where we start. Then let's go to the next biggest advantage. Make a lot more money. And then worry about growing your money, which is where most financial books start, is they go right to the grow your money, and then invest back into yourself and expand everything that you're doing. So that's kind of the 4-part framework of that book. And I feel like we've been taught this industrial mindset for so long that we've kind of adopted it, even though the economy's changed and people are still living in this kind of, work 5 days a week, take 2 off. But a lot of entrepreneurs, it's more like work 7 days a week, try to run faster and make more money. And instead, what I'm looking at is, what if you spent 2 days where you monitored, where you maintained, and you managed everything you did, but then the other 5 days were all about living on point and purpose to make a true impact in everything that you did. And having the financial structure to completely support that so that you felt 100% empowered. You would eliminate one of the greatest destroyers of all wealth, which is scarcity. Scarcity is a place where people are in fear, they're in doubt, they're in worry, they're in concern, or they live in entitlement, or they look to take more from the world than they give. These are the people and the patients that aren't willing to pay for the treatments to get healthy. They just want what their insurance company is going to give, right? It's the wrong mindset. It's part of the epidemic which we're facing here in society. And I'm here to make sure that we abolish that, and instead we embrace economic independence. And economic independence is when you have enough recurring revenue that comes from one of 2 sources to cover your basic lifestyle expenses. The first thing is your investment income. We've somehow adopted this erroneous notion that we should just scrimp, sacrifice, and save. And then if we just wait long enough, take enough risk, and add enough money, that age 65 we could so-called retire. Well, if you're gonna live to 200, that is a long retirement, by the way, that inflation is just gonna kick your ass the whole time. Reagan said I shouldn't swear until 10 seconds in. So I made it to like 2 minutes. I'm really proud of myself. I said I'd use like Utah swear words like hell or heck, Like, and that's, I was speaking in Utah once and I said hell, and someone said that would have been amazing. That was an amazing presentation. It could have been better if you did one thing different. I'm like, enlighten me. You didn't have to swear. I'm like, no, I actually was really deliberate not to swear. She goes, you said HE double hockey sticks. I wish I could make this up. This is really what happens here in Utah. I've lived here for a long time. So economic independence comes from one of 2 sources: investment income, which, what if your mindset in investing shifted to purely you only invest for cash flow purposes until you reach economic independence, and any other investment outside of that isn't worth your time unless it's your business? Okay? See, there's so many distractions that are gift wrapped that look like opportunities. Cryptocurrency, real estate deals that are complicated that you don't understand, tax liens, stock options, I could go on, oil and gas, whatever it is. And if you don't understand it, you don't know it, it's not an investment, it's a gamble. And the problem is there's too many people suffering from health issues in this world for you to gamble with your money, because it requires money to really make a major impact, because you have to hire people, you have to take care of yourself, you have to enjoy life along the way. And if you don't have money, then there's a lot of stress, unfortunately, or you can't hire the right people, you can't invest into marketing, you can't do the things that really can make an extraordinary impact. So the second thing that creates economic independence is entrepreneurial-based income. Entrepreneurial-based income is not the income when you're with a patient. It's the income that comes in even if you're not in the office. So I don't use the word passive income. Some financial people do, and I guess we do a little bit just to keep it simple in 5-day weekend, but we have something called a passive income index, which says there's nothing that's truly passive unless you're part of the lucky sperm club. And then you just inherit money maybe, but you probably still have to like listen to some stories you don't want to hear and maybe like go to some family functions that aren't always the best to get that. There's some, it's not purely passive. But recurring revenue is more about cash flow that you still pay attention to, that you're still responsible for. It's just that you're not on a moment by moment, day by day basis having to do something to have that come in. So it has some leverage, it has some scale. So entrepreneurial income and investment income, if that can start covering your basic expenses, you have this amazing advantage. Like there's one of my early mentors has a podcast called 10 Times, Dan Sullivan. I know there's someone sent me a 10 Times book that I never read by Cardone. Like there's all this kind of 10 times talk out there. And I think it's awesome to have 10 times thinking. But I'm just going to give you the practical way to get to 10 times. Because you can take 10% of your income and try to earn 10%. So now you're getting a fraction of a fraction. And they're going to tell you it's going to take 30 years. And the only time you know that doesn't work out is when you get to the end of the rainbow. And all of a sudden you're like, oh, this sucks. The market didn't cooperate. Or there were a lot of hidden fees that I didn't recognize. Or I didn't save as much as I thought I thought I needed to save less, but it looks like I need to save more. And then what's just so smug and stupid, I'm on one this morning, I could already feel it, is that there's these financial people, they'll be like, how much money do you think you need in the future? Do we really have any freaking clue? Like, how do we know? Like, if I interview people in the 80s, I was really young at the time, but if I interviewed people in the 80s and I was like, how much money would be good to have in retirement? The most common answer would be $200,000 or $250,000 in a retirement plan. What the hell is that going to do for you now? Nothing. So like, let's forget this notion of how much you need in the future, and let's start thinking from optimization, maximum output, the very best that you can do, as much as possible within legal, boundaries, essentially. That's the better way to focus on it. Unfortunately, there's no magic pill out there or magic product. So there's no like financial product that you guys can just go buy and you're wealthy. If there were, I wouldn't have this job, I guess. I'd be doing something else. Maybe I'd be a doctor. I didn't go to nearly as much school as you guys did. And my son would be much more proud of me. Like when I'm flying him somewhere, he's like, we're in his bathroom one morning, we're talking to him, giving him supplements. And he's like, Dad, I'm like, oh yeah, what's son? Why aren't you a doctor? Buddy, I help doctors out. That's what I do. I help the doctors so they can help more people. He's like, be nice if you're a doctor. This kid, like the young one, will like tell you jokes and kind of burn you in a fun way, no scars from it. My 13-year-old will say stuff that it scars your soul for the rest of your life. You're like, dude, and he just goes matter of fact back to brushing his teeth, like, what? I'm just saying. So I should have brought him this morning so you guys could tell him that I'm helping you out. So economic independence is this 10 times factor because it means that all of your lifestyle and living expenses, you don't have to work for. You just have to monitor and manage to maintain that. So imagine what can happen if 100% of your active income could be reinvested into your vision, into the right people for your practice, into the right processes for you to make it more efficient, into the right technology to get even more leverage and advancement. That's a 10 times advantage because everyone else still has that mindset of only having a certain amount of money that they can afford because of scarcity on what they invest in their practice. This is a plague throughout the health practitioners that I see where they don't hire the very, very best because they hire someone that's less expensive, yet the less expensive person produces, according to Steve Jobs, 1/100th of the very best. He said that that was his number one advantage in the world, is that he would just hire the very best and they would outproduce the second best 100 times. And he said nowhere else could you find that kind of return. Or IBM did a study and said it was 5,200% that the A teamers outproduced the B teamers. So when I'm talking about investment, we're not talking stocks and bonds today. We're talking ideas and people. And we're talking about ways that you can put money into the things that you know and understand that are meaningful to you and funding your vision so that you increase your output, which is all about expanding your means. I'm not here to preach living within your means. Yes, live within them, but not by cutting back and having a reductionist thought process. Instead, have an expansive thought process that says, if you want more in the future, it's in direct proportion to the problems you solve, the people you serve, and the value you deliver. I'm going to pause on that for a second, which is not my nature. Faster than anyone could keep up with. So you have to hire us. No. I don't know why I talk so fast. I get passionate. It feels angry at times, but it's just passion. You're not in trouble. So this is an expansion conversation. But in order to expand your means, you're here in the right room to do that, with the right people to do that. So that's not going to be my primary consideration in conversation. I'm just creating that context and giving that permission, not that you need it from me, but just so you could scrub out any of that other thinking that when you hear finance, that it's synonymous with stock market investing, cutting back, and waiting for long periods of time. Instead, I'm going to focus on efficiency. I'm going to focus on how you can live within your means by actually increasing what you spend on the things you enjoy, because we reclaim the cash that's rightfully yours from the IRS, from interest overpayments and banks and institutions, from investment companies and the fees that you pay there, and insurance companies where I know you guys probably love insurance companies and enjoy giving them your money, but I'm going to show you how to give them less and still transfer your risk. So we cool with all that so far? All right. Hey, Ron, give me a 15-minute warning when I got 15 minutes left. So you guys just get to see whatever's in my head. Conversation about my son, here you go. But the good thing is most of it's financially related and will be applicable to helping you. I've been doing a lot of talking this week, so excuse me for the break for water here. Is water's still good, right? Because I'm just confused about it. I mean, there's probably fluoride in it. It's probably killing my kidneys. I feel like I try not to fall too much in love with any one food, because I might find out one day that it's not good for me. But my son will go to his grave that bacon is the best food for you.
Of course.
For you. It's important, you know? All right, so let's get down to like practical things that we can do to put money in your pocket. And I'll start with, I had a meeting yesterday, because I have this methodology that every 3 years I get a different set of eyes on my taxes. And I have a tax team and we meet with them. But I think that this is going to apply to a lot of you. And what you could do is you can go back, and instead of having to write the IRS a check, them write you a check if you overpaid them in the last 3 years. You can amend your returns if you missed anything. So you can go back 3 years. Anyone in the room done any research and development for your practice, for health, for anything in the last 3 years? All right. Did you take Section 199 R&D credits for that? Yeah, okay, so this is a lot of money that we're just gonna like bring back to your life that's just been falling all over the place. I'm sure that the government efficiently deployed it, but the good news is you can have it back, okay? So what you do is, if you were a procrastinator and filed an extension in 2014, you can go all the way back to 2014. If you are too responsible, you miss out. So this is good for the procrastinators in the room. If you're responsible, you can only go back 2 years. If you're irresponsible, you can go back 3 years, okay? So I filed an extension in I filed an extension even when I paid my taxes in full, because I never know, you know, if I come up with some new ideas and I can go back on it. So my suggestion is pay them if you have to pay them, and then file an extension even if you're paid in full. Like I filed an extension this year even though I paid everything. Why? Because I always like to buy time. I always like to keep them on notice that I have some degree of say in this, So just, I'm sure you don't have a lot of financial professionals telling you to file an extension, but I saw a lot of people write that down like, damn, I like that idea. Yeah, let's do that. So R&D and also its cousin, domestic deduction, means you can go back and yes, you may have paid employees. Yes, you may have had expenses, but if you've built software, if you've written books, if you've created content series like video, if you've written research papers, if you've studied something about a technique or strategy or attended an event like this or this particular event, you can go back and instead of just writing off what you wrote the check for, you now get to write off the time that was spent on it if it was a US-based employee. You get to write off the income that came from that at a certain rate. So that's why you would go back for R&D credits and domestic production credits known as Section 199. Now, this so-called amazing tax bill that is, may I say, a huge pile of shit that we got in 2018, it cut out way more than it gave anyone, okay? If you're in the top bracket, you went from 39.6 to 37%. Awesome. I don't really care about that. Even worse, if you're a service provider, which you guys are service providers, did you ever hear about this pass-through deduction that was going to come in the new tax bill? It's going to be this amazing thing. You don't get it if you're a service provider. So that pissed me off because I may not be a doctor. My son may be disappointed, but I work with so many of them. I'm like, oh, this is what you get for going into debt, and taking all this extra time and helping people that you don't get the pass-through deduction. So there is a way to get the pass-through deduction. Here's how you do it. How many people in the room, and if you could show your hands, because I can't read mine, thank God, who here has intellectual property that they've created? Okay, if you've created intellectual property, you can actually set up an intellectual property company. By setting up that intellectual property company, your first advantage is you've created asset protection. You're in a high liability business, and now if all of a sudden you've separated out some of the value into different activities, it's going to be harder for people to get their hands on that than if everything you have is in one entity. Number two, you can actually pay less tax by paying a percentage of all your practice's income to the intellectual property company because it's now paid as a royalty or as a 1099 income versus W-2, but when you pay yourself W-2, you have up to 15.3% more tax because of self-employment. So we can avoid up to 15.3% tax. That's really cool. But now you get the pass-through deduction in your IP company, which could be at 20%. So right there, for some of you, that's 35% savings. So now your effective tax rate might be 15 or 20 on some of your income. All right, so I'm giving you strategy. And I could spout off strategy forever, and it'd be great, but implementing it might be a little bit more complicated. So let me give you the framework so that you could think like this. Because I'm not a CPA. I'm not a tax attorney. I know you guys are shocked that I'm not. My CPA, I almost didn't hire him because he told a joke the first time and it was pretty funny. I was like, dude, that's way too much personality for your profession. I don't know if I feel comfortable with this. Because I said, why should I hire you? First question I asked. And he goes, you like Vegas? I'm like, yeah, I like Vegas. All right. He's like, would you like to make every trip tax deductible? It's like, so you're in Vegas. He's like, yep, you can make every trip tax deductible. I'm like, damn, that's a good argument. You're at least part of the team now. I don't know what else you could do, but we've got one thing down. I actually told him a joke, not quite as funny. I said, dude, you know the difference between an introverted accountant and an extroverted accountant? He said, no, what is that? I said, well, an introverted accountant, when they talk to you, they look at your shoes, at their shoes. The extroverted one, they look at your shoes. I really effed that up, by the way. But you know what I'm saying. And he laughed, which concerned me that he laughed, because I don't like that much personality for these tax guys. So this is the framework. The first thing is you've got to build a team, be proactive with the team, and look at your returns every 3 years by a different set of eyes. So what does that team look like? First off, you got to have a bookkeeper. If you don't give them the data, they can't give you the advice. And if you give them the data late, meaning after the year's over, between January and April the next year, you miss out on all your tax deductions. And about the only thing they tell you to do, and tell me if you've experienced this, is tell you to put money in a retirement plan. Yeah. One of the greatest lies ever told by an accountant is that retirement plans are tax deductible. They're not. They're pre-tax because you don't take constructive receipt of the money, so it never shows up as your income because you forfeited that money to your new business partner, the IRS, and said, great, I'll be your partner. They say, we won't take any money right now. We'll wait till later when hopefully it's grown. And then they can take more. Look, man, those plans, if you have them, I'm sorry. There's at least 3 things you can do about it, though. Number 1, you bite the bullet, you cash it out, you pay the penalty. I know the word penalty scares everybody. I went to Catholic school, it's scary. I got hit in Catholic school, actually, shockingly. So you've got that. Or, number 2, you can roll it over to a self-directed. And that self-directed, you could buy other practices. You could buy land. You have less restriction. So all of a sudden that opens up. Number 3, there's 4. I only told you there's 3. What a great day. What if I told you of 4 and there's 3? It would be a day. But it's now a great day. So number 3 is you can do a 72T distribution. Meaning, by the way, if you're over 59 and a half, you don't have to worry about this. You can just do it. You don't have to do number 3. If you're younger than 59 and a half, normally you have a 10% penalty if you take the money out. But a 72T allows you to start taking money out without the 10% penalty. Or number 4, everyone in the room probably makes too much money if you own your practice to contribute to a Roth IRA. But you get a one-time conversion where you can convert any 401k, SEP, simple, any kind of IRA to a Roth IRA as a one-time activity. And so if you convert that, you have to pay taxes. But there's about a dozen different investments where you can get a low valuation as far as the government's concerned, even though you haven't lowered your cash flow, you've just lowered what is the perceived value of that lump sum. We would call that a rescue strategy. So that would cut your taxes in half. I'll even give you another strategy on this. There's another, anyone in here charitable? Look at only like 3 people. You guys are mean people. What if you're being charitable? I know more of you raised your hand now. I said you're mean. I'm just joking. I mean, I'm charitable, not as charitable as people think. Like, because I donate a lot to my university. I donate all this, but I also do it and get more tax advantage than the donation. So I don't mind the accolades, but I really like the tax advantage. So there's something called a charitable trust that if you're ever to sell your business, you're ever to sell a building that you own that you normally pay tax on, you can move it to a charitable trust, which is any 501c3 that qualifies. Get a tax deduction when you donate it, sell it to whoever you want, have it fund the trust, and the trust has two beneficiaries. You're the first one. You're the first beneficiary of the trust. So now you have a tax deduction that can offset the taxes when you pull money out of a retirement plan. But now you have your full money at work after you sell whatever it is to invest, not the net amount after tax. So you now have more at work. The charity just has to be able to keep, in theory, 10% of that original gift. So charity gets at least 10, government gets 0. Cool? 6 strategies that were bonus. I wasn't planning on giving you any of them, really. So the first thing is you build this team. Bookkeeper, so you have the information. CPA that is a tax strategist, so that they can help you identify your tax deductions. We're going to give you a bunch of those. Third is an attorney or multiple attorneys. Could be a corporate attorney to choose the right corporate structure to classify your income properly, or a tax attorney that could teach you something called tax arbitrage, which are ways that you can just put more money in your pocket than what you spend on different things in the tax world. And then lastly, anyone own their building in here? An engineer. Engineer isn't like a long-term player on the team. It's just a one-time usually, where they can do a cost segregation study and accelerate your depreciation so you can write things off faster rather than waiting for 39 years to get all your deductions. So you build this team, you meet with the team at least quarterly. Sometimes that's 10 minutes, 20 minutes, 30 minutes. It's usually not a really long meeting. And then your job is to be a brainstorming entrepreneur. So you get to say whatever you want in that call and you don't get in trouble with the law. It's only what they file that matters. So I like to ask them questions like, hey, what's the coolest strategy you've done in the last 3 months for any of your clients? Could that apply to me? Hey, can I write this off? Can I write that off? Can I write going to Italy off? Can I write my espresso machine off? Can I write these clothes off that I bought? Like, I just ask them everything. And when they say no, I'm like, but what if I do it this way? Or what if it was like for this? And I just keep going through the questions until they go, dude, you're wasting time. There's no way we're going to be able to write off your clothes. I'm like, wait, do you think that Delta gets to write off the uniforms for their pilots? They're like, yeah. I'm like, what do I got to do to make things a uniform? So I found a way. Now I would say that that's the grayest thing that I do, which isn't bad. Okay, and not in my life, but in taxes. Okay. I've been doing stand-up comedy, so this is why you're getting some of this stuff. But that's the whole job of the meeting, is to brainstorm. Then they're all on notice that every 3 years I'm getting a different set of eyes. And when I get that different set of eyes, all I tell them is, I'll pay your standard fee to analyze everything. If you find anything, I'll double your fee. So I'm incentivizing them to find things. And I don't think that my existing team is bad. I just think that it's a complicated world in the game of tax, right? And so sometimes you get in, like, you probably had patients that they forget to tell you really important things because they see you. It's the same thing in this world of tax. So that's just step one of the framework, is you build the team, you get proactive with them, and you look every 3 years to see if you get them in. That's step one. Step two relates to step one in this. You ask the question, how does this relate to my business with every expense in your life? And if it does, you document it. And you turn that expense into a tax deduction. So examples of expenses that you can turn into tax deductions are kids. I mean, they're lovely expenses 95% of the time. 5% of the time, let's face it, if you haven't had a little bit of hate for your kids, you're lying. You're definitely lying. I really love them. Most of the time. So, I probably wouldn't get Father of the Year after that statement, would I? Yeah. All right, so you could pay them $12,000 a year tax-free. Now, you can't just pay it to them. You have to give them things to do. You can just pay them $2,500 as long as you put them on your website or in your office for a modeling fee. They don't really have to do anything for that. But everything else, you just got to be able to justify. So that'd be one example of an expense turned into a tax deduction. And it used to be $6,300, but the new tax bill gave us a better situation there. Anyone ever have employees, vendors, or clients at their house? Okay, Augusta rule. 14 days a year, you can lease your house out, host a function there. You go ahead and write a check to yourself from the business. You don't have to claim that as personal income, but that's a full tax deduction to the business. So depending on where you live and the value of your home, calculate that. Let's say that I did mine only during the lowest times in Salt Lake. The inversion's happening. There's no time to, every hotel's giving rooms out for $100 and I charge $2,500. If I did $2,500, 10 times a year, that's $25,000 that used to be taxable income that now comes to me tax-free. It's more like $60,000 for me because I do it during conference weekend when all the Mormons gather together here in Utah and there's parking lots are empty at the churches and the hotels are full. I'm like, sweet, we're definitely having some beverages at my house to celebrate, right? So that's $7,500 because that's what it would cost to get a room. This room would triple during that time. So that's the Augusta rule. Or I have my office at Wealth Factory, which I'm heading to after this, which is just like a mile from here. But I also have my intellectual property company that I've talked to you guys about creating that needed an office separate. So it could be a different company. It's just a better story that way. So I kicked my kids out of their playroom. Once again, I'm definitely winning Father of the Year here. I'm taking them to Avengers today, which maybe that's bad too, because they're 10 and 13, and there's a lot of violence, you know. I tried to kick my son off YouTube the other day because of the language, and he goes, like, they're definitely not swearing as much as you, Dad. It's like, I like, valid point, but I still told you to get off that.
Or I hear this at the art school.
So, oh yeah, dude, my son is so sweet, other than when he cuts at the soul, but he's like innocent sweet. So he comes home from school and he's like, Dad, hey, like, the kids are swearing at school. And I told them they're not 18 years old. I'm like, buddy, that's kind of a house rule, not like a universal rule. So we say, wait till you're 18. They can kind of do what they want. Can I like have a word? I'm like, what word are you thinking? And he honestly pulls me in the bathroom and shuts the door and whispers in my ear, can I say the DAM word? I'm like, as long as you don't add an N to the end of it, then we're totally cool, bro. So anyway, deductions into expenses into deductions. I now have a home office. I get to write off half my utilities, right? I get to write off a bunch of stuff that I do at the house. Not everything, but because it's on a separate floor, that's helpful. There's so many deductions that people miss out on. And a lot of accountants will say, I'm really conservative. Let me tell you what that means. I'm missing a lot of deductions. So when you find out, I already told you I'm conservative. Like, don't do things that are illegal. But why not take advantage of every opportunity you have within the law? Okay? So, first thing was build the team, be proactive and man. Second thing is turn your expenses into deductions by asking how it relates to the business, and documentation is your key. Document it. I have the weakest documentation that you can have because I have a memory like a champion, and I know that I could crush any IRS person because I'm a storyteller. So it's a sales job if they want to debate me on one of my deductions, I'm going to be able to give them plenty of reason why it was deductible. But all I do is I get my American Express bill, and I just write which company needs to pay for that expense and what it was for. My CFO prints out a paper for every expense that's fully detailed and has like green folders hanging. He's 18 years older than me and the opposite of me. You'd think he was in the military, always perfectly, he would have a tie, a pocket square today, you know, like the whole thing. I decided to take off my jacket. Hopefully I'm still impressing you. I don't know. I just felt like this was more comfortable. You're at least enjoying it and brave enough to be up here. So the third thing here is the biggest way to save tax by far. The reason why it's most neglected, and just this third category is why for every $500,000 I see people make, they overpay tax by an average of $11,470 per $500,000. That's if I throw out the top 20%, because the top 20% make that number over $30,000 per $500,000. Meaning that there's some people that are so good at overpaying tax, I don't want to skew the numbers, right? Reclassification of income. There's 3 ways you do it. You turn your active income into passive income for tax purposes. You turn your ordinary income into capital gains. You turn your taxable income into tax-free income. That's the process. So how do we do that? Active income into passive income. All of you that raised your hand saying you own a building, you charge yourself the highest possible rent based upon everything that's comparable, because rents will be less taxable than your active income. If you're the only person in your practice, you have no other partners, you set up an S corporation. In that S corporation, you take a reasonable salary, which isn't what you're worth, it's what you would pay a new associate to do the job. And then you take the rest in a distribution. That distribution avoids the self-employment tax of 15.3%. Even when you've maxed that out, it saves you a minimum of 3.2% or maybe another 3.7%. So somewhere in the 3.2 to 15.3% range, simply because you're taking the exact same amount of income, you've just differentiated it into salary versus distributions. Okay? Those are just 2 examples of active to passive. How do we go from ordinary income to capital gains. Well, if you own a business, you already have done that to a certain degree because your business is a capital gain, that if you've owned it for longer than a year, that when you sell it, it's a capital gain. But even better is if you now understand when you sell your business, there's multiple ways you can do it. We talked about a charitable trust. That goes from taxable to tax-free to even giving you a little bonus kick of tax benefit, right? If you've never heard of a caps trust, that's a way that you might be able to go to taxable to potentially tax-free, or at least tax distributed over time. Or if you got an organization with 25 people, you could do an ESOP where you could actually, if you ever want to sell your business, because I like the thought of retiring in business, not from business, you could sell your business to your employees, and that would be funded by the bank, even if they didn't have the cash to buy the shares, and you don't pay tax when that money comes in if it's in that ESOP structure. So I just gave you 3 taxable to tax-free, ordinary income to capital gains. The way that I did it was a risk management strategy. We all face risks. You guys probably face, most of you should face more risk than me, but with the way I talk, I probably face the most risk in the room. Someone's like, aren't you afraid of getting audited? I'm like, I hope to get audited because it's just research for my firm. I've been audited twice. I didn't owe any extra money. They thought that because I declared myself a real estate professional, which at one time I had over 100 properties, which gives you unlimited depreciation and deductions that everyone else has limitation on. They tried to debate it, so I just had to prove out the amount of hours we spent. We won in the audit. But you should only be afraid of auditors if you don't have a good tax team, you're not well documented, and you've done something illegal. The number one thing that you do illegal in the United States around tax is not report your income. If you reported 100% of your income, the only other major concern to have is if you take a tax deduction that you feel is in the gray area, that's more than 20% of your overall tax deductions. So this one deduction, let's say, is greater than 20% of your overall deductions, and they disallow it, it's a 25% penalty. So if it's less than 20, it's a 9% penalty. That's not a bad interest rate, single digit, right? So I actually set up an insurance company called The Captive where I put money in pre-tax. I can insure anything that happens in my business, employee turnover, reputation management, like all the stuff you normally can't even buy, cyber risk, whatever might be hard to buy insurance for. But if I never have a claim, I get to take that out capital gains, which is essentially close to half of my ordinary income. You don't rush out and do that. Most people, that doubles your audit risk. That is probably the thing that gives me the most attention from the IRS that I do. But I just wanted to give you examples. See, because rather than scrimp and save and wait for 30 years to hopefully get to a place where you're retired and then all of a sudden you're taken out of service, we need what you guys do. The only retirement that I hope you ever do is retire from the things that you hate doing and continue on a purpose that's so compelling that you make a massive difference in the world. And if you get economically independent, you can swing for the fences in that, knowing you're not going to put yourself at financial risk. So, all that being said, if I could save you thousands upon thousands of dollars of tax, I can save you 10 years or more. Because how long and how much money would you have to save to create that same amount of cash flow in your life? I'm about efficiency and capitalization, intelligence instead of sacrifice. I think beyond just what people do for their health, there's another major 3 factors that kill people off early. The first is not being in control of their money and understanding what's going on. And almost every retiree is not in control of their money because they're a slave to either interest rates that are low, and if they keep going low, their income goes lower. Taxes fluctuating. If taxes go up, their income goes lower. And inflation confiscating their purchase power. So they don't have a lot of control over those 3 things if they're so-called retired. If you're in business, you have a lot more control over those things. So what I want to make sure is that people don't win the wrong game, essentially. And if you are not in control of your money, then what starts to happen is relationships suffer. When you're really, really stressed about money, is that you at your best and most pleasant? And when I see people strained with money, they're not going out and doing fun things with their relationships. And so all of a sudden, if you're not in control of your interest rates, they go down, so does your social life. And then the third thing that destroys longevity is a lack of purpose. So money, relationships, and purpose. You add that combination to health, you got someone that makes it a long time. You look at Viktor Frankl and what he did with purpose. If you read Man's Search for Meaning, he overcame the greatest odds. Those people that didn't have purpose, they just said, I can stay till the new year. If we could just make it to the new year. Well, the new year came and that was their whole purpose. Guess what? They didn't make it. He said, I got a story I got to tell the world. I got something I've got to share that's meaningful. He figured out how to be more resourceful to get there. So yes, this is a financial program that understands that the center and heart of your life is you, your ability to produce, and that you are your greatest asset, not a stock, not a bond, and not a piece of real estate.
Want to master your money? Want to figure out the things that you could do to improve your finances? Click here and check out more videos like this on Money Matters.